Right, so welcome to another video of ours. My name is Robin, and as per usual, I am joined by Kirill. If you've seen our previous video, you won't be surprised about this video, or at least about this topic, which is going to be gold. So in our previous video, we stated that basically the market on its own is pretty overvalued, as its growth of the price are not really supported by the underlying factors, right, such as GDP growth, inflation, just industry as a whole. So where do people park their money normally? It's either bonds or gold. As there is a limited supply in gold, people feel safe storing their value there. So today we thought it would be really cool to look into another perspective of obtaining gold without obtaining the physical asset, which is looking into a gold stock. In this case, Franco-Nevada, which basically is an asset manager when it comes to gold, but also has some production facilities.
Absolutely spot on. Yeah, just to add up on that, right? So when it gets to, let's say, yes, safeguarding your money, it's nowadays there are like only limited options. So apart from, let's say, gold and the bonds that Robin mentioned, there's also could be cryptos, right? But these are a little bit more volatile, and they're also a little bit of a more, let's say, risky side, especially when it gets to the investing in the stocks, when it gets to related cryptos, right? So that's why we also decided that gold could be one of the good options when it gets to hedging, right, against of these, let's say, crisis situations that we discussed in our previous video. So if you would like to learn more, please check out our previous video. First of all, link would be in the description to get to know more about the macroeconomic outlook and how things are actually going in reality versus what the stock market is showing us and presenting us with the unicorn and rainbow environment where everything is just all-time high. So yeah, let's get into it, I guess. So
Yes.
we'll just pop up our lovely spreadsheet, soon to be a web app, hopefully.
So
Yeah.
so we didn't really do our normal introduction as we do, right? So we just discussed the introduction of why we are going to talk about gold, but we're going to continue on what is this company? Are there any potential of growth? Like, what do we think are its fundamentals? Then we're going to stick a price to it, and then we're going to tell you at least where you can do this kind of valuations yourself, right? So first, this is Franco-Nevada Corporation. So they're based, I believe, somewhere in Canada. Basically, they are a gold assets manager, and 55% of their assets are gold. The other percentages are other materials such as silver and also mining. So we thought it would be interesting. Of course, you can go out and buy gold, but there are other ways to get exposure, which is one of the ways is to buy a stock based on a gold corporation. So what are some of the fun things that we can see, Kirill? Because I think we can already see some green.
Yeah, and I'm also, to be honest, I'm very surprised because also just for you guys who will be watching it, we did not really do any of the digging, let's say, when it gets to the company, right? So we just kind of just decided to see, okay, what could be the potential investments opportunities when it gets to gold, right? And this was one of the companies. But if you actually look at it from the perspective of a fresh site, right? I'm really happy to see very high gross margins of 65%, the return on invested capital of 11%, which is also great. The company is paying a dividend, and the payout ratio
Yeah.
of it is not that big. It's below 30%, right? And they do not really dilute you a lot. So yeah, you're very right. It actually looks like one of these tech companies, to be honest, just
Yeah,
when it
I
gets
was
to numbers,
seeing.
right?
Yeah, I see a modest PE of 22, which is crazy these days, right? I don't
Yeah,
think we've seen that in the last, I don't know, 6 videos.
yeah,
It's all above like 40.
yeah,
So what else do we see? We see revenue growth in 5 years, net income growth 5 years, free cash flow growth. Their debt is covered by their free cash flow. Like you said, okay, they're diluting, but 0.17%, something you won't like to see, right? But
yeah,
on the other hand, you have your dividend growth of
yeah,
more than 6.5%. So these things are already pretty good signs.
yeah,
And as you said, like we just thought to engage in this company because it was, it had a lot of assets in gold.
yeah.
But it's good to see that, yeah, this might be a really good company to look for into.
Like, to be
So
honest, I would even consider like digging into it further, at least from the fresh
yeah,
side. So yeah, when it gets to the share buybacks part, it's not, let's say, that big of a deal, to be honest, because 0.17% is nothing. It's merely zero. So that's, I would say that's completely alright, you know. And what's good to see also that they do not have any R&D, right? If we scroll further down, they do not
yeah,
have any interest expenses, which is also a great sign, or it's pretty much
yeah.
1%. And selling and general expenses also almost zero.
So just to cover these statistics further, right? So like you said, it's really good to see net earnings ratios. You want this to be above 20% easy. They make a lot of profit, so they don't have any difficulty converting their revenue into profits. And that's what you're saying. Like, okay, we can see this further in the R&D. Of course, they have gold. What do they need to invest in? Gold is a thing. You don't need to. You don't have gold plus or subscription to gold.
Yeah, yeah.
So yeah, it makes perfect sense. The selling and general expense ratio, for me, I didn't know this company, but they might have some good brand recognition, or they have very good customers, or the people who entrust their money in gold with them. Okay, and so what's also interesting to see here is their depreciation to gross profit margin. So you see it huge jump. So that might be some kind of facilities where they need to store things, right? Or
Yeah, so that's
stockpile.
interesting, right? So they were, it looks like they're piling up on it, right? So it's either they probably thought that there was some good prices they could pick it up at, right? And then just pile up the inventory with, or they thought like, okay, maybe that's gonna be a very lucrative option for us to sell it at higher prices later. So
Yeah,
that's the question, which is also very interesting to look at, right? But at least if the like the prices for gold are going to be increasing, that's definitely going to be a good signal for this company for sure.
exactly. And there's something you might want to dig in deeper to see why that happened. So the average depreciation versus their gross profit margin isn't that bad. It's 40% only 20, which is good. But if you want to know why they did this, you can just go into their annual earnings calls, for example, and check out what they did. Yeah, what else do we see? We see the same thing. So they've been growing the dividends 7% a year. Yeah, their share outstanding, they have been diluting a bit.
Yeah.
And it also is around the same time where they started also uh, doing that, maybe stockpiling or getting some more assets in order to either delve for more gold. And that's also the point where they started diluting. So that
Hmm.
might also be acquisition of some, you know,
Could be very well. Yeah, maybe they
uh,
acquired a related business or something. So this is also that's also a very good point, Robin. So this is again just another indicator for you to check out why exactly did why there are such high fluctuations, right? So you can also see, for example, from the free cash flow. Jesus Christ, it's a little bit late already, but from free cash flow growth perspective and from the revenue growth perspective, it fluctuates around quite significantly, right? So it could be because of course, the volatility of the prices for gold itself, right? But also could be different things. And then again, this is also for you guys to do your homework on and conduct your due diligence. So yeah, exactly.
yep. So for Fundsmith, do you see anything that you want to talk about?
I'm the only thing I am No, to be honest, I'm very happy with all of these because they got very high gross profit margin. The operating profit margin is also great because they literally almost have zero operating expenses, which is amazing, which is always great to see. Return on capital employed is, let's say, it's around the average for the market. It's all right. Could be better, of course. And cash conversion has been also fluctuating all over the place. So again, this could be uh, just an option for a hedge. It's doesn't necessarily mean that it could be a good option for long-term investing, or it's just very the stock could be very influenced by the macro developments and just changes in gold prices. So this is also something for you guys to keep in mind. So let's say if the gold prices are gonna go down, most likely the stock prices of this company is also gonna go down.
Yep.
So shall we get to
Mhm.
the most important part?
Yes.
Yes.
So we want to, of course, we want to know what is the value you can stick on this ticker symbol, right? So, okay, it's trading for some price, but what is the actual underlying value of this business that they're offering? So there are a couple of things in our tools that you can manipulate. So it's the analyst or your for a forecast for the percentage growth of the company, the PE, their 5-year high or low. Basically, we're trying to calculate their average PE and what it might be what might be trading for in the future. Required rate of return, we have this normally above 10%. Normally for an ETF, for example, you're expecting 7 to 10% returns. But because you're stock picking, you're having that much more risk. You want to cover it, and that's why you want to have a high rate of return. And we do this at a modest 12%. But of course, if you want to have more risk and you want to find those companies that are trading for a bigger discount, you can increase this. Discount rate, we leave this at 12%. And margin of safety, this is something that's also, again, something uh, relates to you, right? If you're older and closer to your retirement age, you don't want to really get into risky investments. You don't want to lose all your retirement money. Whereas when you're 20, you have such a long, yeah, lifespan ahead to recoup losses or potential losses. So you can put it safer. For example, now Kirill and I, we don't really know this business, right? We just picked it up out of this, thin air. I don't know how much you know about gold and the mining industry or whatever. So you can crank it up, right? So for example, we can say, okay, at least I think I speak for the both of us, where I can say, okay, put this between 30-40% because we don't really know the industry. Um, and yeah, you can also discount the cash flow formula, and you can do it either by 2, 5, or 10 years, depending on where you see the company going within this time frame. So first of all, let's see the endless growth points. There are a couple of things or ways how you can do this, right? You can check out, for example, cash flow growth, revenue growth, net earnings growth. So you'll take it away. Let's do it your way first.
Yes, sir, absolutely. So for this, we could either check it in our spreadsheet directly, right? So for example, for the revenue growth for the past 5 years, it was around 14%, and for the free cash flow growth, it was negative 60, which is quite different. Let's say when it gets to that. So if you also wanna, for example, go and check for a little bit further period of time, you can go to websites such as Stock Analysis, and that's what we just did. We just plug in the company in here, and we can just check the cash flow growth, for instance. And yeah, to be honest, that's not very good representative because it fluctuates a lot. But we can, for example, just check the revenue growth. That's hopefully going to be a little bit more consistent. I can just, for example, just plug it in here. Yeah, so it's around
Like 12,
13%.
14%. Yeah.
Yeah.
And then the other way, what we can do is you can, because of course there are analysts who do this as their full-time job. So we can go to Yahoo Finance, go to the stock analysis, um, and then go all the way down, and you'll see what the analysts think. So for the next 5 years, per year, they think they are growing with around 8% per year, but they are expecting a decline of 2.9% next year, which is kind of odd considering that they have all-time highs with gold, or they know something that we don't know.
It also could be the question, when was the last time this forecast was updated? That's the thing.
That's true. Yeah.
So that's why we could probably put something in between, let's say 8% and 13, right? Maybe
Yeah.
let's do 10, because then we can also we can always see like how does it change. We could always make it smaller, considering that, like, yeah, there could be additional risks, etc., etc. So
Okay, so we go to the next part, of course, is going to determine the high and low PE ratio, the average PE ratio. You can go to macro trends, and here we do it for 5 years to see what the fluctuations are.
yeah,
Um, yeah, there are some high fluctuations, right? 120. It's not per se an outlier, it's just trading at a high price. But as it turns out now, it's just trading for way cheaper.
Yeah, I
What do
think
you...
that was around the times when the COVID hit, right? So that could be
Exactly.
attributed
True.
to
Yeah.
this dip. But like, yeah, if we take something like a normal behavior of the P, that would be lows of 30, probably
Yeah.
the highs of,
100.
yeah, 100, yeah, which is
Yeah.
still quite expensive. And well, luckily enough,
Yeah.
already had the similar assumptions before
I,
then.
yeah, exactly. I think it will be more representative to be around 30, to be honest.
Hmm.
If we are seeing for how it's been trading lately.
Yeah,
But we can change it as we go. We can check it out first
yeah,
on this, and we can maybe then do the PE for 30, 40, for example.
yeah,
So
correct.
what do we see?
Um, if we discount this, the cash flows for this company for 10 years, that's actually around a fair price. Only thing is, you would rather buy it for way cheaper, around $60 in comparison to the fair value, right? If you want to have like some solid premium. But to be honest, I'm not even surprised because people have probably priced it in, right? They
Yeah,
expected that the gold was already trading at rather high valuation, right? And if we, for instance, lower down the fork for the PE, so let's say 30, 50, but if we can still, let's say, increase the growth points to, let's say, 14, right? Still more or less the same.
yeah,
If we do 8%, what the analysts say, then it's going to be even cheaper. So we're talking about $80 per share instead of versus the currently traded of 106. So maybe not this company, but something related to it. Or let's say you could always pick up the gold ETF, exchange traded funds, right? Where you would have the basket of all of these companies related to gold mining and exploration and yada yada yada. But I guess this specific one is, it looks good, but there are like two things I don't like: high valuation and the company's tendency to fluctuate and be dependent on the gold prices. That's the thing.
yeah. I agree. Yeah. So there's a couple more things that you might want to look into before buying this, right? And I think that's a perfect bridge to when it comes down to that this is not any financial advice. So whenever you want to base your decisions, base them on your own judgment, calculations, and knowledge. And then afterwards, I think the biggest question to ask is, where do we get the sheet
Oh,
or the web app?
that's the best question you could ask for this whole video.
Oh,
Yeah,
yes.
yeah, yeah, absolutely. So you just go to our website 930.com and you can just click on get access today, and it's just gonna quickly redirect you there. The deal is very simple. It's only €1, a one-time purchase, no subscriptions or whatsoever, because we also want just to bring you guys on board. And by buying the spreadsheet now, you also lock yourself into the web app that we're developing, which is soon going to be available, hopefully within a couple of months. Yeah, quick and dirty. So guys, if you like it, if you like what we're doing, if you don't like it, or if you want to just comment on top of what we're saying, if you're interested to see some additional companies that you would like us to look into, let us know in the comments. Thanks for watching, we really appreciate it. And anything else to add, kind sir?
Yeah, like and subscribe if you want. Stay tuned for more videos. And with that said, have a good one.